There is one aspect of this whole, taking advantage of the conjuncture theory that has apparently gone unnoticed by everyone. Taking advantage of the situation is of great psychological importance for the speculator, because he wants to get his profit in a short period of time. The idea of having to wait a year for your shares to rise in value is repugnant to you. However, the waiting period, by itself, has no significance for the investor. What is the advantage to the investor of having his money divested until he receives some, presumably, trustworthy signal that it is time to buy? You will only have an advantage if by waiting you are able to buy later at a price low enough to make up for your lost dividend income. What this means is that carrying out operations based on the situation has no real value for the investor, unless said moment determined according to the situation coincides with that determined according to the price, that is, unless it allows him to return to buy its shares at a price substantially lower than the previous sale price. In this sense, the famous Dow theory on buying and selling based on the situation has been the subject of a very unusual story. In short, this technique interprets certain special market rallies that exceed the average price levels as a buy signal, while it interprets certain special market falls that cross the average price levels as a sell signal. The calculated results, which do not necessarily are real, that would have been obtained with the use of this method, showed a virtually seamless series of trading benefits from 1897 to the early 1960s. On this account, the practical value of the Dow theory would seem firmly established. The question, if any, would be about how reliable this published record would be as a reflection of what a person applying Dow's theories would actually have done in the market, not as to their validity. A more detailed study of the figures indicates that the quality of the results produced by the Dow theory changed radically after 1938, a few years after the theory had begun to be taken seriously on Wall Street. His most spectacular achievement had been in giving a sell signal at 306, about a month before the crash of 1929 broke out, and in keeping his followers out of the prolonged period of market decline until the situation it had pretty much corrected itself to the 84 level in 1933. However, beginning in 1938, the Dow theory had worked mainly by driving its adherents out of the market to a reasonably good price, but introducing them back into the market at a higher price. For almost 30 years from 1938, substantially better results would have been obtained simply by buying and holding the DJIA. In our opinion, which is based on extensive studies of this problem, the change in the results experienced by the Dow theory it is not accidental. It reveals an inherent characteristic of the operating formulas and forecasts in the field of business and the finances. Formulas followed by supporters that gain importance do so because they have worked well for a period of time, or sometimes simply because they have been cleverly adapted to the statistical records of the past. However, as its acceptance increases, its reliability tends to decrease. This occurs for two reasons. Firstly, the passage of time brings new conditions that the old formula is not capable of accepting. Second, in the evolution of the stock market, the popularity of a theory of operation itself has an influence on the behavior of the market, and this reduces its chances of generating profits in the long run. The popularization of a theory like Dow's could apparently give rise to its own justification, since it would cause a market to rise or fall by the simple action of its followers when a buy or sell signal was given. Such a stampede would, of course, be much more dangerous than advantageous to the public operating in the market. This method has the double appeal that it is apparently logical and conservative, and that it shows excellent results when used applied retrospectively to the stock market over many years from the past. Unfortunately, its acceptance increased precisely at the moment when it was destined to offer its worst results. Many of the people who applied these formula plans found themselves completely, or almost completely, out of the market at some of the levels reached in the mid-1950s. They certainly made some excellent profits, but generally speaking the market flew away from them the moment they got out of it, and their formulas gave them not the slightest chance of ever making a comeback. A position in shares. There is a similarity between the experience of those who adopted the formula investment method in the early 1950s, and the who adopted the purely mechanical version of the Dow theory 20 years ago before. In both cases, the popularization of these postulates indicated practically the exact moment at which the respective systems they stopped working fine. We have followed an experience similarly embarrassing with our own central value method of determination of indicated levels of purchase and sale of the Dow Jones Industrial Average. Apparently the lesson to be drawn is that any method of making money in the market that can be easily explained and followed by many people is by its very nature too simple and too easy to last. Spinoz's conclusive indication is as applicable to the market of values as well as philosophy. Everything excellent is as difficult as it is rare.